Hi, it's Dre Griggs with Obsidian Wisdom, and the last thing that you need is the strategies for rebalancing. We're going to focus on three of them, then we're going to start with the simplest, and we're going to work our way to the slightly more difficult. So the easiest way is what we call calendar rebalancing, a very fancy way of saying that once a month, once a quarter, or once a year, I'm going to look at my assets, and if my percentages are off, I'm going to rebalance them. So if I wanted 20% of my portfolio to be in real estate, and I found out that only 15% of my portfolio was in real estate, and I was coming up on my review, so if that's once a year, I would say, okay, that means I need to buy 5% more of the real estate asset class. So I would go buy 5% more of my real estate funds. But to figure out where to get that 5% from, I need to figure out what overperformed. So then I would look at my assets and I would say, okay, it looks like my investments in treasuries actually outperformed, where I wanted 20% in treasuries and I found myself with 25%. Okay, well, that means I need to sell that percentage from treasuries to buy that percentage in real estate. And I would make that adjustment, which, as I mentioned to you earlier, means that I'm going to sell high and buy low because real estate is not performing well. That's why it only has 15%. And treasuries is performing very well. So that means I have extra profits. That's why I'm at 25%. So if I sell the 5% profits and buy in real estate at a low point, well, I should feel really good from an investment perspective. Now, that's counterintuitive to the way most of us feel when we see this happening in the stock market. Most of us feel if my real estate went down 5%, that I'm losing money. So I should sell all of my real estate, which is selling low, and I should buy all the treasuries, which is buying high. You see people buying in AI stocks and the metaverse stocks and cannabis stocks, that there's always something that's kind of going on. And whenever we get all excited, we end up joining the party a little bit late, which means we're really buying high. And so when you do these reallocations based on a particular time of the year, whether that's once a month, once a quarter, once a year, I know some people that do it once every 2 years, but they have a higher risk tolerance. And the idea is I want to allow that growth to happen, that maybe I sold and it was at 5%, but maybe it would have went up to 30% and I could have had a 10% profit. Now, the reason that is considered a higher risk is because you're allowing that asset to continue riding. And you're basically saying, I'm going to see how long this can go. And depending on that, naturally, that may go well and it may not go well. Now, I won't go into it too much here because it's a very advanced approach, but you could buy a put to protect yourself from the market going down where you lock in some of those gains. Now, granted, you have to pay the cost of purchasing the put option, but at least you don't have the risk of losing a significant amount of your gains because you are protecting yourself against the downside of the market. And so that works for some people. But again, it's a very advanced strategy, and it's probably one that doesn't necessarily make sense to talk about in this particular video, but it is one that I can put together if you guys share in the comments that is something that you would like to see. The second rebalancing strategy is called threshold rebalancing. And the way this strategy works is you're not focused on one particular time of the year. It doesn't matter what the calendar year is what the percentages of my allocations are. And so in the same one that we just did where I wanted 20% in treasuries and I wanted 20% in real estate, I might say, well, if I ever get more than 30% in real estate, I will then make the asset allocations to rebalance my portfolio back to the original intent of my investments. Or maybe you only do it 5%. I know some that are as high as 15, 20%. But again, the higher the percentage, the more risk that you're taking on. If you require your portfolio to be 20% out of whack for you to be able to go in and do the rebalancing, well, that means that at any particular time that you actually have 20% more risk than you had originally designed your portfolio to have. For most retirees, 5% is probably where it makes the most sense, where every time you're outside of 5% of your investment allocations that you would rebalance it back. Now, you can review that number where you'll say, all right, well, I'm out of 5% every 3 or 4 months, and that doesn't make as much sense to me, Dre. I would at least like to do it once a year. And I would say, sure, that's fine. Do it once a year. And then we can change either the threshold. So maybe we go up to 10% or 8%, or we can change the rebalancing strategy that you use and we can go to a calendar-based approach. But that's the way that thresholds work, is whenever I pass a certain percentage off of whatever my asset allocations were supposed to be, I will immediately then go and make the buy sells necessary to rebalance my portfolio. And the third rebalancing strategy, and probably the most complicated one, is called tactical rebalancing. And that is I'm invested in a certain asset class because I believe that that asset class is going to perform very well based on research conditions, et cetera, et cetera. And anytime I find a better asset class to invest in, I will be willing to sell all of my assets in this class, or at least significantly reduce it, and I will buy assets in that next asset class. So maybe during COVID in 2020, you were looking at the market and you said, oh, healthcare is a great sector for me to invest in. I'm going to remove my assets from leisure because they closed everything in leisure, and I'm going to buy the asset classes in healthcare because everyone is diverting their money into the healthcare sector, right? Like that makes sense. Now, the issue with the tactical approach, or at least the slight difficulty that we have, is it really depends on how engaged you are in the market and how well you can read this information. Because you have the information, but do you have the wisdom to be able to understand what strategies and what adjustments that you should make based off of that information? Because I'm sure we've all been there at least one point of our lives where we heard the same information as someone else, but we drew a completely different conclusion than them. Where we heard the same information and we were thinking, okay, well, that person is guilty. Or maybe we were thinking you can never vote for that person. And then someone else was thinking that person is clearly innocent. And they're thinking, I would always vote for that person. But we heard the same information. We just drew different conclusions. That is why tactical rebalancing can be something that's very difficult, because it's not always as clear cut as COVID, where I can immediately say, well, it's obvious that leisure is not going to perform well, and it's obvious that healthcare is going to perform well. Because I could make equally the case that that means it's a great time to actually move into leisure, because these are artificial events that have happened. Because technically, the bones of all of these companies, these movie theaters, these cruise lines, these theme parks, that hasn't changed, and that means that leisure hospitality is on sale, that I could invest in amazing companies at a very low price because COVID has created this artificial deflated environment to where all these prices have gone down. I can make the case either way, but it really depends at what particular point in time are you looking at this information as far as deciding which one makes the most sense for you to do. Now, whatever rebalancing strategy that you decide to use, it's important that you don't go too far and become an active day trader where you're just adjusting all the time. You're looking at the economic conditions, because that is very risky and is not necessarily going to be cost effective for you. Every time you trade, there's probably going to be transaction costs and tax implications of those trades. Now, for someone who wants to streamline it, you could hire a fiduciary financial planner such as myself, or you can take advantage of technology and some automation tools that will rebalance it for you on its own. You do want to still take a look every so often. You don't want to just set the car and then go to sleep. You often want to still look to make sure your car is making the best decisions, that we're still within the guardrails and the parameters that we set, where we didn't accidentally fat finger a button and now the automation is not actually following the investment strategy that I set. But for most people, it just makes sense to have some preset triggers. And we've been discussing them, whether it's a particular date, whether it's a particular threshold. I find that that's what makes sense for me. You don't want to have to necessarily go out there and just buy these target date funds. If you look at some of the costs of a target date fund and all they're doing is these rebalancing, that's actually more than paying a financial planner who would actually give you an entire comprehensive, holistic approach, where this is what you're just paying someone to do the rebalancing, where you have a target date fund of 2054 or 2030 or something like that. And all they're saying is, I'm going to allocate these investments to where it gets progressively safer. We're focusing more on preservation than we are in growth. And we're going to make sure that if someone was to retire on that date, so for example, target date fund 2030, that is an asset allocation and rebalancing that's aligned with the strategy of someone who needs to retire by 2030. Well, you could do that. We've just gone over it. You can actually streamline it yourself. But if you are someone who wanted to pay someone to do it, it totally makes sense to pay a fiduciary financial planner when you look at some of the cost of a target date fund and you're not getting anything but the rebalancing. If you think of it, if you could just imagine paying a financial planner just to do the rebalancing, you would probably sit there and say, I feel like you should be doing more for me. And that's how I feel about the target date funds. They have a high cost structure tied to them, and they're only offering rebalancing services. So if you're someone who could do it on your own, save yourself the money, I've already outlined the approaches that you would take. If you're someone who wants to pay someone to do it, then I would say look at fiduciary financial planners. If I was talking to you as if I was talking to my parents, I would say look at fee only fiduciary financial planners. Well, that is it for today's video. I'm always thankful for our time together. If you found value in it, go ahead and hit the like and subscribe button so you can continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.